The IMF has downgraded their outlook for growth in many parts of the world. I think much of the strain we're seeing reflects the impact of Russia's brutal war against Ukraine, which has raised energy prices. Of course, he's weaponized natural gas, which is causing huge price spikes and energy strains in Europe. We still see the impact of COVID in China and the slowdown in Chinese growth. And with high inflation and tightening monetary policy in many advanced countries, emerging markets from really all of these factors are suffering many stresses. So there's a lot to talk about. But from the perspective of the United States, I think the United States is doing very well. And we had an employment report just last Friday that shows we continue to have a very resilient economy, an economy, of course, that's slowing, which is something we expected fully after a very strong recovery. We essentially erased the shortfall in output from its potential. The ARP accomplished that. We would expect slower growth, but we still had over 260,000 jobs last month, and have a very strong job market, although we're beginning to see some signs that pressures in the labor market are easing. So I remain encouraged. The U.S. economy is strong, and as I've said on other occasions, I think there's a path through. Obviously, inflation is too high. It's a priority to lower it. But I think there's a path to accomplish that while maintaining a healthy labor market.
Is the U.S. really strong right now economically? The stock market has gotten crushed. So have U.S. bonds. The CEO of the biggest bank, J.P. Morgan, Jamie Dimon, told us this week that he expects a U.S. recession in the next 6 to 9 months. Well,
look, we're going to see, and can't be sure, but I'm very encouraged by a continued strong labor market. People feel good about the labor market. They're, of course, concerned about inflation, and we need to bring that down. But household balance sheets remain strong. Firms, even with rising interest rates, have debt burdens that are, by and large, manageable. And while there's been a good deal of financial market volatility and some concerns about liquidity and the potential for liquidity strains in the Treasury market, we really haven't seen signs of financial stability in the United States. In our financial markets, they continue to function well, and we're not seeing signs of deleveraging of the kind that sometimes occurs in an environment of tighter monetary policy. So I think the U.S. economy continues to do well.
On the bond market point, you're not seeing any strains on liquidity because the market has been extremely volatile.
Well, there have been a lot of underlying shocks, decisions, for example, OPEC's unfortunate, very unfortunate, and I think unwise decision to reduce oil production. So there have been shocks and shocks relating to Russia's war against Ukraine, and other, policy shocks. Right? Obviously, I'm not going to talk about Fed policy, but it's clear the Fed is committed. They've set out a plan for how they're going to tackle inflation, and I think that's pretty well understood by the market. So while there is some concern about liquidity in the markets, I don't think we've seen anything that rises to the level of a serious concern.